In less than 3 minutes, let's talk about some things you probably didn't know about individual retirement accounts or IRAs. An IRA is a savings account with tax advantages that individuals can use to save and invest long term. You can think of an IRA like a 401k, but 401k is set up through an employer, and an IRA you can set up by yourself. You can set up an IRA on top of the 401k. Any person, regardless of age with earned income, can open an IRA. You can open your IRA with a bank, investment company, or a personal or online broker. There are several types of IRAs: Traditional IRA, Roth IRA, SEP IRA, and SIMPLE IRA. They all have different rules as far as eligibility, taxation, and withdrawals. The contribution limits for Traditional IRA and Roth IRA are $6,000 or $7,000 if you're age 50 or older. Keep in mind that it's $6,000 total between Traditional IRA and Roth IRA per taxpayer. If you're a couple where only one spouse works, can contribute to the spouse's IRA who doesn't have an earned income. That's called a spousal IRA. If you're a small business owner or a self-employed individual, you can set up SEP and SIMPLE IRAs. Otherwise, you can set up a Traditional IRA or a Roth IRA. A SEP IRA stands for Simplified Employee Pension IRA. The IRS provides business owners, independent contractors, freelancers an opportunity to set up SEP IRAs to contribute toward their employees' retirement as well as their own retirement savings. For the year 2021, SEP IRA contributions are limited to 25% of compensation or $58,000, whichever is less. However, employees are not allowed to contribute to the SEP IRA. This is just for the employers to contribute for their employees. A SIMPLE IRA is also for small businesses and self-employed individuals. The acronym SIMPLE stands for Savings Incentive Match Plan for Employees. SIMPLE IRA has the same withdrawal rules as a Traditional IRA. Unlike the SEP IRA, a SIMPLE IRA allows employees to make contributions to their accounts while their employers are required to make contributions as well. All of their SIMPLE IRA contributions are tax deductible to potentially lower their income tax bracket. The SIMPLE IRA employee contribution limit in 2021 is $13,500 and the catch-up limit for age 50 and older is $3,000. The main difference between a Traditional IRA and a Roth IRA is when you want to pay your taxes. If you choose Traditional IRA, then you're making contributions with money you may be able to deduct on your tax return. However, you will have to pay taxes when you start withdrawing at 59.5. With a Roth IRA, you're making contributions with money you've already paid taxes on, so your money in the Roth IRA will grow tax-free and you won't have to pay taxes on withdrawals when you turn 59.5. Keep in mind, you can directly contribute to the Roth IRA if your modified adjusted gross income is $140,000 or less as a single tax filer and $208,000 or less as joint filers. Traditional IRAs do not have any income limits. There's a way to get around the Roth IRA if your income is too high, and that's called a backdoor Roth IRA. You can check out my other video about my Fat Fire retirement plan with backdoor Roth IRA. Thanks for watching. Check out these 2 3-minute videos as well as the new Fire video coming out tomorrow, Sunday at 9 a.m. Have a good one. Thanks for watching. Don't forget to hit the like button and subscribe for more Fire videos.